So the market starts to fall, and it's easy to panic, right? But what if you had a clear, calm checklist to get you through it? Well, in this explainer, we're going to build just that, a solid strategy to help you navigate these corrections with a whole lot more confidence. Let's jump right in. This is the big question, isn't it? You open up your portfolio, you see all that red, and you feel that knot forming in your stomach. It happens to everyone, but what you do next, well, that's what separates a panicked reaction from a disciplined investment. Before you even think about your stocks, the very first step is to check in with your own mindset. You know how it is. The financial news gets louder. Influencers are screaming about the end of the world. They feed on that fear. But you've got to remember, while we can't control the market, we absolutely can control our reaction to it. Just think back to the COVID crash in 2020. The fear was overwhelming. But the people who tuned out all that noise and just stayed the course, they saw the market triple over the next 4 years. That's the power of keeping a level head. Okay, so before you make any moves, no buying, no selling, the first thing you have to do is check in with yourself. Seriously, this isn't about the stocks just yet. It's about understanding you, your temperament, your financial situation, and your psychological limits. This self-awareness is honestly your best defense against making a big emotional mistake. Let's just be brutally honest here. If your portfolio took another 20% hit from where it is right now, how would you really feel? Would you be up all night staring at the ceiling? If the honest answer is no, then you know what? The smartest thing to do is just wait. And look, that doesn't make you a weak investor. It actually makes you a really smart, self-aware one. Protecting your own peace of mind is always rule number one. You know, market corrections feel massive when you're in them, but if you zoom out on a long-term chart, they usually just look like tiny little blips. If you need this money for a house down payment next year, it has no business being in the stock market. But if your timeline is 5 years or even longer, then you have the single most valuable asset an investor can have: time. Time for the market to do its thing and recover. All right, this next one really depends on where you are in life. If you're in your 20s or 30s, you've got decades of paychecks coming your way. A market dip today isn't nearly as scary because you know you'll have more money to invest later, maybe at even better prices. But if you're getting close to retirement, you won't have that fresh cash flow, so protecting the capital you already have becomes way, way more important. Okay, this one is absolutely critical. It is so tempting to see your favorite stocks on sale and just want to throw every last dollar at them. But where's that money coming from? Are you dipping into your emergency fund? Cashing out other assets? Don't do it. Investing borrowed money or cash you need for other things is a recipe for disaster. You should only be investing with true surplus capital, money you can genuinely afford to lose. All right, so you've gone through the personal checklist, you've said yes to all the questions, now what? How do you actually start buying? The key is not all at once. A much smarter approach is to average your way in. Maybe you start with a small position, say 3% of your portfolio. Then, if the stock takes a big dive, like 20–25%, you add a little more. And here's the secret sauce, the built-in limit. By stopping at a set ceiling, like 6% total, you stop yourself from getting emotional and throwing good money after bad if a stock just keeps falling. You know, at the end of the day, it all boils down to this simple choice. You can look at the drop through the lens of panic and fear, or you can look at it through the lens of logical opportunity. A great company doesn't suddenly become a bad company just because its stock price fell. It just means that great company is now on sale. If you can really embrace this mindset, you can turn a scary correction into a massive opportunity. Okay, so it's time to shift our focus outward. If we're going to treat this as an opportunity, how in the world do we find the quality companies that are actually worth buying? Well, it comes down to a pretty simple checklist. And this leads to a decision that can be tough, I get it, but it's so important. Think of your portfolio like a garden. Would you ever waste your best fertilizer on a tree that you know will never give you any fruit? Of course not. A market correction is the absolute perfect time to weed the garden. Sell those weaker companies, even if it's at a loss, and put that money into your strongest fruit-bearing trees. You just can't let your ego trap you in a bad spot. So what makes a company strong enough to buy in a downturn? Here are 3 easy filters. First, is it a leader in its industry? When times get tough, the weaker players often go under, and the leaders actually grab more market share. Second, does it have a long history? A company that's been around for 20+ years has probably seen a few recessions and survived. And third, and this is maybe the most important one, does it have a healthy balance sheet? So when I say healthy balance sheet, what does that even mean? It's pretty simple, really. It just means the company has the financial muscle to get through a storm. When the economy slows down and sales start to drop, a company with low financial stress can hang on, while its weaker competitors, well, they might not make it. So, what's the number one thing to look for? Easy, low debt. Think about it. When the economy gets tough, sales go down. If a company is saddled with huge debt payments, it can't survive that for very long. But a company with a ton of cash and very little debt, it has breathing room. It has the resilience to not just survive the storm, but to come out on the other side even stronger. Okay, we've covered a lot, right? Mindset, your own financial situation, how to analyze a company, but we can actually boil all of this down into one single powerful question that you should ask yourself before every single investment decision you make from now on. And here it is, the big one. This one question cuts through all the noise, all the fear, all the hype. What this question does is it forces you to zoom out and think really critically. Is this stock truly the absolute best place for your hard-earned money out of all the other possibilities in the entire world? If the answer isn't a confident, immediate yes, then you wait. This is your ultimate filter for building a portfolio you truly believe in and navigating any market with calm and confidence.